expandCFO.
Problem isn't your bookkeeper, it's the setup. You're doing everything you can and the numbers still don't add up. That's not your fault, and it may not be your bookkeeper's either. In fact, they might be doing everything right inside a system that's completely wrong. But the stress of managing growth with disconnected tools, lagging reports, it's real. And your bookkeeper may not have the experience to help you scale your financial infrastructure as you scale the business. Listen, if you've ever Googled or ChatGPT'd, why can't I trust my financial reports? These may be some of the answers. Maybe your business has outgrown your bookkeeper. When your business was smaller, cash-based accounting was just fine, made the most sense. But a common scenario we see as the business grows is there's a large divergence between cash basis and accrual basis accounting. For example, as volume increases, you may need your suppliers to do larger production runs for you. This expands the order lead time and can lengthen the time from when you paid your deposit on that inventory to when you receive and resell the product and get the money back. If this is accounted for on a cash basis, then that upfront deposit, it's booked to COGS expense way before you recognize the sales for that product. This makes for some wonky gross profit margin calculations. No wonder you feel like you can't trust your financial reports. But to be fair, you can't ask someone making 60 grand a year to do $1 million CFO thinking. It's just not fair to them, and it's not doing you any favors either. It's time for you to stop being penny wise and pound foolish when it comes to your accounting and finance function. Invest in the right team to give you the insight you need. Another reason why you can't trust your financial reports? Maybe your accounting is being done on QuickBooks when you need a full ERP like NetSuite. We commonly see businesses add more systems and complexity as they scale. Pretty soon, you have this hodgepodge of systems that don't talk to each other. Orders come in via Shopify. They're fulfilled and shipped using Shopify's shipping labels. But revenue's booked in QuickBooks based on when the payment settles, which could be before, maybe after you actually fulfill the order. And then COGS only gets entered at the end of the month based on an outdated spreadsheet that is someone's best guess of how much inventory you have on hand. Because of all these timing differences, you don't ever really know if that month's gross profit margin is correct. But you think the average of the past few months should be about right. No wonder you feel like you can't trust your financials. Most business owners have someone doing the books. What they don't have is a proper team and system that turns that data into insight. This means they're looking through their rearview mirror instead of focusing on the road ahead. What you really need is a finance team and system that scales with you from 5 million to 50 million. So what's the fix? It's not hiring another full-time person. It's not buying yet another tool. It's rethinking the entire finance setup from daily and month-end workflow to clear ownership and impactful reporting. So let's stop blaming the bookkeeper and fix the whole system instead. We've already helped dozens of founders build a finance team and reporting engine they can trust. If you're ready to get out of the weeds and into the driver's seat, then send us a note. This is for the CEO that's tired of guessing numbers. Running a business is hard enough. The weight of growth, people, and pressure can keep you up at night. I've been there. You've probably searched, what is a fractional CFO, or heard the term without clarity. And if you're like most CEOs I talk to, your reaction is somewhere between, I think I need one, and what do you actually do? Let's break it down. So what does a fractional CFO do? Honestly, you can easily find hundreds of people that can tell you what a fractional CFO should do. But I'd rather tell you the top 5 things a good fractional CFO does not do. 1, they don't just show up and throw up with the financials each month and drown you in spreadsheets. Instead, a good fractional CFO will identify the most important variances from budget and prior periods and highlight them in a dashboard so you can focus on making changes where it matters most. 2, an awesome fractional CFO doesn't just meet monthly to review what's happened after the fact. Instead, they're a partner with you during the month and help you understand how the daily operations affect your bottom line. They help you develop daily operational scorecards that can hold all employees accountable for what they do each and every day and help them understand how they affect the business's bottom line. This way, the future financial results of the business are being driven by what you're doing today instead of you learning about what happened 30 to 60 days after the fact and you can't do anything to change them. 3, a great fractional CFO doesn't overcomplicate things. They keep it simple, stupid. It actually is much harder to distill the financials into simple and concrete issues instead of just reporting on everything and showing fancy charts and models. Sure, those fancy slide decks look nice. Can you easily recall what changes you need to make based upon them? The answer is most oftentimes no. If your CFO can't give you simple answers, then they simply don't understand what's going on. 4, a good fractional CFO doesn't think they're too good to roll up their sleeves and do some bookkeeping work. I'm not saying they should spend most of their day doing bookkeeping, but they need to understand what's going on and make sure they can trust the numbers. Because with financial reporting, you get garbage in, garbage out. Trying to drive some fancy financial forecast without first kicking the accounting tires could lead you to steering the business off the road. Here's a controversial POV for you. I think the best CFOs have an accounting background and not just a finance background. And 5, the most valuable fractional CFOs don't just say yes and tell you what you want to hear. Instead, they push back and question your ideas based on data and financials. And they help you identify the worst case scenario, which actually can help you sleep better at night and reduce founder anxiety. Seriously, once you write down or model out the worst case scenario, then it's less daunting. You are no longer scared of this unidentified boogeyman in the dark. Once you've seen the worst case and you shed light on it, you can start to plan on how to avoid it, which can actually be really energizing. When you know you have a CFO that will tell it to you straight and they've helped you understand your cash position and profit margins and cash forecast, then you stop waking up at 3 a.m. wondering if you can afford payroll. Fractional CFOs can lower the mental load of leading a growing company, which as you can be a very lonely position to be in. If your vision is scaling and your numbers aren't keeping up, let's talk. We've helped visionary CEOs like you bring strategy back into the numbers. Let's make finance a key growth lever for your business instead of it being a business liability. Have you sunk a ton of money into NetSuite but aren't seeing any ROI? You're not using NetSuite wrong, and you're not alone. You just don't have the system set up like the profit engine it could be. Let's start with this dirty little secret. Most NetSuite dashboards, they are just vanity metrics. They look nice, but they don't tell you why your margins are shrinking or where your cash is going. To turn NetSuite into a profit engine, you need 3 things. 1, you need real-time visibility into gross margin by SKU, sales channel, and by customer. 2, you need true landed cost tracking. And 3, insight into inventory turnover by SKU. Here's a client story I feel will resonate with you. We worked with a distributor doing $25 million a year in revenue. They called us because they couldn't understand why they didn't have more cash flow despite growing top-line revenue a bunch over the last few years. And their controller was never really happy with their switch to NetSuite and was never going to learn a new system properly. He had no idea how to harness the powerful data in NetSuite to help them make changes. Their NetSuite reports showed 60% gross margins. It sounded great, but after digging in, we realized tariffs weren't being tracked in landed costs, shipping costs were dumped into an overhead account, discounts weren't even tied to customers properly. Their real margin, 35%, almost half. That took them from, hey, we think we're doing great, to why are we always tight on cash? All of those costs that should have been up in COGS were just being expensed as overhead. No wonder they couldn't grow the business to profitability. They were actually growing the business broke. If you related to the story and you're struggling with NetSuite as well, leave a comment below. I'll share any thoughts I have to try and help. So how can you set up NetSuite to avoid these margin mistakes and increase cash flow? The first thing we did for this client was we took over their accounting function so we could control the accounting process to ensure their NetSuite data was accurate. And we trained their AP specialist on how to properly record the freight in bills and tariff expenses to be booked as landed cost. There are a few different ways that landed cost can be configured in NetSuite, depending on your flow and the timing of bills. We configure the system to be the most efficient for them. This is one reason why having someone with expertise in both accounting and NetSuite administration is really helpful. Second, we help them update their BOMs to include direct labor in the item cost. This allowed them to see the real contribution margin of a product after labor cost. You don't need the fancy advanced manufacturing module in NetSuite to do this either. Just add a service item to the BOM that reflects the estimate of the labor cost. After these changes, they could then easily see the true contribution margin for each product after all associated direct costs, including labor. Once we had that, then we just had to optimize sales for their highest margin products. Third, we helped our client build a dashboard that shows their top 10 items by revenue, along with their gross margin by item. They found they were running around really busy selling a lot of low margin products. This helped them decide to focus on higher profit margin products and focus their cash flow and labor towards those items instead. We also built a dashboard that showed them contribution margin by customer. Similar to focusing on their most profitable items, they started focusing on keeping their most profitable customers happy. Our client was always dealing with back-ordered product. At least now they knew which customers to prioritize over others. Finally, we helped them compare their inventory turnover ratio by item versus its gross margin. Again, we had them prioritize their highest selling and highest margin items to make sure they always had sufficient stock for these items, even if it meant their back orders increased on the lower margin items. The result was they became less busy, improved their profit margins, and improved their cash flow from efficiently buying the right inventory. Any business can do the same analysis. The key is that you have NetSuite configured properly and the right accounting team to run it. So yeah, NetSuite can be a beast, but if you tame it, it'll pay you back every single day with maximum ROI. You just have to stop using it like a ledger and start using it like a lever. If you're open to ideas on how to increase your NetSuite ROI, feel free to subscribe to our channel. And if you'd like to see how we could help you, please click on the link in the description to contact us. See you on the next episode.